Hey Pit Buddies, welcome back to the channel. Today we're going to be talking about something that every trader runs into, whether they know it or not. The market's invisible walls. You can't see them at first, but they're there, waiting to stop price in its tracks, bounce it back, or set it free into a new direction. These walls are called support and resistance, and if you want to make sense of why price moves the way it does, you need to know where they are, why they form, and how to use them. This isn't just theory. Support and resistance are practical, tradable concepts that guide your entries, exits, and risk management. They work in day trading, swing trading, long-term investing, you name it. And once you start seeing them, you'll wonder how you ever looked at a chart without them. So grab your mental hard hat, because today we're going to be learning to build and navigate these walls like a pro. Think of a chart like a battlefield, right? Price is a soldier, moving forward, retreating, dodging attacks. Support and resistance are the front lines, the points where opposing forces meet and battle it out. If you're only looking at indicators or news headlines, you might think price moves in random zigzags, but once you overlay support and resistance levels, the chaos starts making sense. You see that price doesn't just stop anywhere. It stops where traders, big and small, have placed their lines in the sand. Ignoring these levels is like driving through a city without knowing where the traffic lights are. Sure, you can move, but sooner or later you're gonna be slamming on the brakes unexpectedly. Support is the market's floor, the point where falling price meets enough buying interest to stop the drop, at least temporarily. Picture dropping a basketball. Every time it hits the ground, it bounces back up. That ground is your support level. In trading, this happens because buyers step in, thinking the price is low enough to be a good deal. Sellers might also close their positions here, adding buying pressure. Here's an example. Let's say Euro to USD has fallen to 1.0500 several times over the past 3 months, and each time it bounced back up. That's not a coincidence. That's a level where traders have consistently decided enough is enough on the selling. The more times that bounce happens, the more other traders notice it, and the more powerful the level becomes. Support is a magnet for attention, and the more it proves itself, the more traders trust it. Now, flip the story. Resistance is the market's ceiling. It's where rising price meets enough selling interest to stop it in its tracks. It's like a balloon hitting the roof. It can't go higher unless enough force builds to break through. Traders might think price has gotten too expensive, so they start selling. Others who bought earlier take profits, adding more selling pressure. If GBP JPY has struggled to break above 184.00 for weeks, each rejection reinforces that level as resistance. And just like with support, the more failed attempts, the more dramatic the eventual breakout could be. Resistance is a point of hesitation, but it's also a point of potential, because when it finally gives way, the move that follows can be explosive. One of the coolest things about support and resistance is that they can swap roles. This is called role reversal. Imagine you're playing soccer and you've been defending one goal. Suddenly, halftime ends and now you're attacking that same goal. Same field, same goalpost, completely different purpose. In trading, when price breaks through a support level, that level often becomes new resistance. And when price breaks through a resistance level, it often becomes new support. This happens because trader psychology flips. If a support level breaks, buyers who entered there may want to exit on a retest, adding selling pressure. If a resistance level breaks, sellers who shorted there might rush to close their trades, adding buying pressure. What was once the floor can become the ceiling, and what was once the ceiling can become the floor. Finding these levels isn't about drawing lines all over your chart like spaghetti code. It's about spotting where price has reacted strongly before. Look for areas where price reversed direction multiple times, stalled and moved sideways before continuing, or spiked and then immediately returned. When you see those patterns, you've probably found an important level. It's important to think of these areas as zones rather than exact lines. The market is not precise to the pip because it's influenced by human decisions, algorithms, and liquidity. Price might reverse a few pips above or below the exact level you've marked. Think of these areas like wide speed bumps. Sometimes you slow down before you hit them, sometimes right on top of them, and sometimes just after. At support, traders see value. Buyers jump in, sellers close shorts. At resistance, traders see overpricing. Sellers attack, buyers take profit. This repeated behavior is why these levels are so self-fulfilling. Even if the logic is purely psychological, as long as enough traders believe in a level, it will influence the market. This is also why historical levels can remain relevant for years. That high from 2018, it can still matter today because traders remember it. When price approaches an old level that once caused a major reversal, traders will anticipate it could happen again, and that anticipation alone can cause it to hold. When a strong level finally breaks, it's often like opening floodgates. Breakout traders pile in, momentum builds, and price can run hard in the new direction. But not every breakout is the real deal. False breakouts happen when price pokes through a level, lures traders in, and then snaps back inside the range. It's like stepping into what you think is solid ground only to fall through a trap door. The best way to protect yourself is to wait for confirmation. That might mean waiting for a full candle to close beyond the level, watching for unusually high trading volume, or seeing if price retests the level and holds before moving further. Patience here can save you from some of the most frustrating losses in trading. Support and resistance aren't just for identifying pretty chart patterns, they can directly shape your trading plan. You can use them to time entries by buying near support and selling near resistance, to set stop losses just beyond a level to give your trade breathing room, or to plan take profits at the next key level above or below. Even if your strategy relies heavily on indicators, you should always consider where your trade sits relative to these zones. An overbought reading in the middle of nowhere might mean very little compared to an overbought reading right under a major resistance level. One big mistake traders make is cluttering their charts with too many lines. Not all price reactions are equally important, and making every single one will just confuse you. Focus on the levels that have been tested multiple times and caused clear reversals or pauses. Another mistake is treating these levels as unbreakable. They hold until they don't. And your job as a trader is to be ready for either outcome. A bounce or a break. A third mistake is ignoring time frame context. A support level on the daily chart might be irrelevant for a 1-minute scalp, but it could be critical for a swing trade. Always check multiple time frames to understand which levels matter for your style of trading. So there you have it. Support and resistance, the market's invisible walls. They're the floors and the ceilings that shape price movement, the battlegrounds where buyers and sellers face off, and some of the most reliable tools you'll ever have as a trader. In the next video, we're going to be zooming in on candlesticks and specifically what those little wicks are actually telling you about market battles. You'll never look at a chart the same way again. If you enjoyed this, do hit that like button, support the channel in this early phase, share your best support or resistance trade in the comments below, and subscribe so you're ready for the next lesson. Until then, keep your eyes on the walls, because in trading, knowing where they are is half the battle.